Rows of Japanese motorcycles, Honda, Yamaha, Kawasaki, and Suzuki, are sitting unsold, waiting months on showroom floors as dealers quietly cut prices and offer incentives. The post-pandemic surge has faded, and with U.S. sales dropping over 5% in 2025, some are now asking if we are witnessing the start of an inventory collapse for these legendary brands. What set this cascade in motion, and how vulnerable is the network beneath the surface? In 2020, Japanese motorcycle manufacturers faced demand unlike anything seen in decades. With public transit limited and travel restricted, consumers across the United States and Japan turned to motorcycles for personal freedom and recreation. Dealers, eager to capitalize on the surge, placed aggressive orders for Honda, Yamaha, Kawasaki, and Suzuki models, convinced the boom would stretch on. Factories responded by ramping up production, pushing output levels well above historical averages. The mindset inside both dealerships and original equipment manufacturers was shaped by memories of missed sales during previous upswings. No one wanted to be caught short. This over-ordering was not unique to motorcycles. It echoed the behavior seen during the period from 2008 to 2010, when similar optimism led to inventory pileups and eventually manufacturer buyback programs to clear unsold stock. But in the pandemic era, the scale was even greater. Dealers filled their lots with new inventory, betting that the wave of new riders would continue. Manufacturers, seeing order books swell, increased shifts and stretched its supply chains, assuming that every bike built would find a buyer. By late 2022, cracks began to show. The initial burst of demand faded as lockdowns ended and economic uncertainty grew. Yet the production pipeline kept flowing, with 2023 and 2024 models arriving at showrooms already crowded with unsold bikes. Dealers found themselves managing aging inventory, sometimes holding units for more than 90 days, well beyond the industry-preferred 45 to 60-day window. The result was a glut of motorcycles, deepening discounts, and rising pressure on the entire dealer network. Factories and retailers alike now face the consequences of decisions made during the pandemic-fevered months. By 2025, the motorcycle market had settled into a quieter rhythm. The initial rush of buyers faded, and the numbers told the story. United States sales slipped 5.3% to just over 507,000 units, while Japan's domestic market posted a similar decline. Showrooms that once buzzed with activity now faced a different reality. Bikes lingering on the floor far longer than dealers or manufacturers expected. For many buyers, the decision to purchase a new motorcycle became less impulsive and more calculated. Rising living costs and economic uncertainty meant that every monthly payment, every insurance quote, and every fill-up was scrutinized. The profile of the typical buyer also changed. Younger riders, who once gravitated toward high-performance sport bikes, began favoring smaller displacement models and adventure bikes, machines that promised versatility and lower running costs. Kawasaki, for example, saw almost 40% of its Japanese sales go to riders under 35, a clear signal that the next generation was looking for something different. Dealers started to notice this shift firsthand. Models that had once been reliable sellers, especially in the supersport and naked bike categories, began to gather dust. Meanwhile, demand for entry-level and adventure bikes remained steady, even as overall volumes declined. The market contraction was no longer just about fewer sales. It was about a fundamental change in what riders wanted and what they were willing, or able, to afford. This new landscape put added pressure on pricing and affordability, as both buyers and dealers adjusted to the realities of a post-boom marketplace. Sticker prices on new Japanese motorcycles have quietly climbed year after year. By 2026, the average MSRP for a mid-range model sits above $12,000, a figure that would have seemed unthinkable for many buyers just a decade ago. For someone financing their purchase, higher prices translate directly into higher monthly payments. Compared to 2019, buyers are now facing payments that are 20 to 30% larger, even before factoring in rising insurance and fuel costs. These numbers matter. For a growing number of would-be riders, especially younger adults, already squeezed by rent and living expenses, the cost of a new bike no longer feels justifiable. Many pause at the prospect of a 5-year or 6-year loan on a depreciating asset. The appeal of walking into a showroom and riding out on something brand new has faded, replaced by a more cautious, budget-driven mindset. As prices outpace wage growth and lenders tighten credit standards, affordability becomes the main barrier, pushing more buyers to consider alternatives outside the new bike market. A wave of repossessed motorcycles has swept through the used market since 2022, reshaping the landscape for both buyers and dealers. Lenders, facing a sharp rise in loan defaults, sent an estimated 2 to 3 million motorcycles through wholesale channels by early 2026. Auction lots overflowed with recent model bikes, many purchased during the pandemic-era boom, now selling 30 to 50% below their original value. For example, a sport bike that fetched $12,000 in 2025 might bring only $8,000 at auction today. This dramatic drop in wholesale pricing is not just a statistic. It is a force that pulls potential buyers away from new showrooms, tempting them with nearly new machines at a fraction of the cost. Dealers, already burdened with aging new inventory, now face a double squeeze. The flood of cheap repos has made it nearly impossible to justify the price of a new bike, when similar models, often with low mileage, are available for thousands less. Wholesale buyers and auction managers report desperation sales, with lenders accepting steep losses just to clear space. The result is a used market that undercuts new sales at every turn, forcing dealers into tough decisions. They can discount aggressively to compete, or hold inventory and risk further margin erosion as bikes continue to age on the floor. Floor plan financing sits at the heart of every dealership's operation. Dealers rarely buy new motorcycles outright. Instead, they rely on lenders to advance up to 95% of the bike's invoice price, using each unit as collateral. This system works when sales are brisk and inventory turns over quickly. But with bikes now sitting unsold for 90 days or more, the math changes fast. Interest on these loans accrues daily. For a mid-range motorcycle with a $20,000 invoice, holding that bike for 180 days can cost the dealer $7,500 in interest alone, not counting storage or depreciation. As inventory ages, lenders may demand partial repayments known as curtailments or raise rates, squeezing margins even further. Dealers facing a glut are forced into tough choices: slash prices to move metal, or risk breaching loan covenants. The pressure is real. By early 2026, at least 73 dealerships had closed their doors, unable to absorb the carrying costs of unsold inventory. For many, floor plan financing has shifted from a tool of growth to a source of existential risk. Rising costs now shape every decision in the motorcycle market. Inflation has pushed up the price of ownership across the board. Insurance premiums and fuel expenses alone have climbed 10 to 15% since 2022. In Japan, these pressures have taken a visible toll. Domestic motorcycle sales fell to 348,400 units in 2025, a drop of nearly 5% from the previous year, as buyers hesitated in the face of higher prices and uncertain economic conditions. For many households, the total cost of keeping a bike on the road now rivals the monthly payment itself. These financial headwinds are not limited to one country. As interest rates remain elevated, financing a new motorcycle becomes more expensive, and dealers in both Japan and abroad report fewer first-time buyers willing to commit. The environment leaves little room for error. Manufacturers and retailers must now operate in a climate where every extra cost can push a potential buyer out of the market. Japanese manufacturers now face a crossroads. With unsold bikes stacking up and discounts cutting into profits, the traditional playbook offers a few options. Some brands have already begun to quietly space out production runs, slowing the flow of new models to dealers without making public announcements. Factory-backed incentives, like cash rebates or low-rate financing, are being deployed to help clear aging inventory, but these tools can only go so far before eroding margins. Model pruning is another lever. Yamaha, for instance, trimmed its Supersport lineup in recent years, quietly discontinuing models that no longer matched buyer demand. Each of these moves comes with trade-offs. Production cuts risk losing market share if demand rebounds, while aggressive incentives can damage brand value. The decisions made now will determine whether the Japanese motorcycle giants weather this correction or face deeper structural challenges ahead. Right now, Over 500,000 new Japanese motorcycles wait for buyers in US showrooms. As affordability pressures mount and dealer risk grows, the industry stands at a crossroads, not just for bikes, but for the business model itself. The next move will shape the future of riding.